Happy Thursday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Thursday, December 12th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how inevitable is a too strong US dollar? Our answers are, yesterday we asked the question, when will dollar strength become a headwind to US assets? The latest global macro news flow begs today's key macro question. In China, forward guidance from the annual Central Economic Works Conference supports a weaker Chinese yuan. In the Eurozone, the latest action and forward guidance from the European Central Bank supports a weaker euro. In Switzerland, the latest action and forward guidance from the Swiss National Bank supports a weaker Swiss franc. In Canada, the latest action and forward guidance from the Bank of Canada supports a weaker Canadian dollar. In the US, the latest key economic data supports a stronger US dollar. Specifically, the November CPI and PPI data were highly supportive of our 36-month-old sticky inflation theme and suggest our 14-month-old Jay wants a soft landing theme may culminate in 2025. Factoring in the likely evolution of relative forward rate pricing, the Fed funds rate is likely to get trapped 100 to 200 basis points or more higher than the policy rates of its peer central banks in the coming quarters. Transition to our 42 macro dashboard, as always, wrapping up with a question from our community. This one's regarding taxes and KISS being our systematic trend following KISS portfolio construction process that we use to help our retail investor clients retire on time and comfortably. Says, good morning. I would bet that DD has gone over this, but what's the plan around short-term gains and taxes in the KISS portfolio? So the answer is definitely yes. Just type in the word tax in our AI-powered search, and you're going to get a lot of different client conversations, of which I've chimed in, specifically how we think about taxes with respect to KISS, our systematic risk management overlays, whether it be KISS, which is for retail investors, or our discretionary risk management overlay, aka Dr. Mo, which we use to help our institutional investors and very sophisticated retail traders remain on the right side of market risk. So either or, you're in one of those two buckets if you're a 42 macro client. And so specifically with respect to those risk management overlays and how we think about taxes, I'll just answer the question specifically. What's the plan around short-term gains and taxes in the KISS portfolio? I don't know what your plan is, because obviously we have different plans. Each one of us has our own unique tax liability situation. My plan is to pay the taxes on the gains that we've experienced here in KISS. There's a tremendous amount of gains that we've all benefited from as a result of KISS's bullish signals all throughout this rage bull market that we've been on the right side of fundamentally for most of the past 2 years, and specifically and explicitly since the beginning of last November. In fact, the beginning of last November was the last time KISS bought the S&P 500 for the first time. So we're going to get whenever we do sell the SPY ETF, there will be a long-term capital gain associated with that purchase. But there are short-term capital gains associated with the purchase of Bitcoin and gold. I think we had a small loss on gold in the most recent sale, but that's neither here nor there. That's all. It doesn't make a difference. What I'm trying to say is that your goal as an investor should obviously to maximize your returns on a tax adjusted basis. But the most important part of that solution is maximizing the return. And the way in which there's sort of three different buckets that investors sort of seek to maximize returns. And in my opinion, only two of those buckets actually work. So there's kind of one bucket. The first bucket is probably the kind of top 1% of investors who have not only the acumen to find and highlight the best investments that are going to perform well over a long multi-year time horizon. Not only do they have the acumen to identify those things ex ante, they have the all caps emotional discipline to let those things run and not trade them, not sell them too soon, or not constantly overtrade their portfolio, which is what most investors are doing, including a lot of institutional investors. They have the emotional discipline to just kind of sit back and just let the money make itself and let the money work for its let the money make the money. So I think of folks like Warren Buffett, Charlie Munger. Those are the types of investors that really understand kind of long-term the benefits of long-term compounding, and also have the emotional discipline to not succumb to their own action biases. So that's sort of, I would say, in the top 1% of investors. I would say the 99th percentile to investors to 90th percentile investors, so sort of the top decile minus the top 1%, those investors understand that one, it's hard to consistently predict which investments are going to, dramatically outperform over a multi-year time horizon. And more importantly, they may not have the same level of emotional discipline to avoid trading their portfolios. And so they ultimately, what they do is they supplement their, obviously, top-notch, fundamental investment processes with, top-notch risk management processes as well. This is what all the top buy-side institutions are doing. They have risk management overlays to coincide with their fundamental research processes. The fundamental research process tells them what do they like and what do they not like. Specifically, what do they want to overweight or underweight, and then their systematic risk management process tells them when to overweight or underweight the things that they do not and like. So those are two separate processes. One is more qualitative, typically, and the other is more quantitative. So that's what we do here at 42 Macro, is to sort of marry those two separate parts of our process to produce risk management results. And producing those risk management results, sometimes you wind up with long-term capital gains, and a lot of times you wind up with short-term capital gains. Specifically as it relates to KISS, there's 4 on average going back throughout the duration of our out of sample back test, which begins in January of 2018. There's an average of 4 trades in KISS per month. So obviously you're going to be generating some short-term capital gains and or booking small losses to remain on the right side of market risk. But ultimately, what KISS allows investors to do, and same thing with our discretionary risk management overlay, is it allows you to, what it's trying to do is making sure that you're, based on the quantitative risk management signals that support those processes, it's constantly trying to make sure that you are oriented for what the most likely path forward is for markets from a momentum and volatility standpoint. And so obviously, if you think about it, if you're, if you're sailing a sailboat, you're constantly reorienting the sails to take advantage of what the wind, the winds that are being provided, as opposed to the winds that you would prefer to be provided. Those are two very separate things. And so ultimately, you are going to incur some tax liability. But in my opinion, I think that's a better outcome than, I would say, which is what the bottom 90% of investors, the bottom 9 deciles of investors are probably out there doing, which is assuming that they have the ability to consistently sell the top of every market cycle and consistently buy back in on the bottom of every market cycle. Actually, that's probably not the bottom 90th percentile investors. I would say the bottom 50th percentile investors are the folks who are going to hodl all the way through a significant drawdowns, like a lot of folks in the crypto market plan to do. That, in my opinion, no offense if that's you, but that, in my opinion, that's the bottom 90% of investors on the full distribution of investors. Again, there's a distribution for every single thing of which there is more than one unit, more than one. When the population equals N plus N, there is going to be a distribution of that. And so I don't say this pejoratively. I just say this, that you're on this side of the distribution and Warren Buffett's on the other side of the distribution. And so specific, going back to kind of the top 90th, so the 90, so the 50th to 90th percentile worth of investors, those are the investors that obviously understand investing and understand that the goal is to maximize upside capture in bull markets and minimize downside capture in bear markets. But the way in which they go about that is, in my opinion, sort of somewhat unsophisticated and probably it suggests that they lack the relevant experience to kind of get themselves into the top decile. And what I mean by that, going back to what I said earlier, there's a lot of investors out there that believe that they can sell the top of every market cycle and buy the bottom of every market cycle on a consistent basis. I mean, the number of people in the history of investing that can do that consistently is like 5. Stan Druckenmiller, it's Paul Tudor Jones. It might not even be 5. So, it's Stevie Cohen, maybe. That's a maybe. Kenny Griffin, maybe. Izzy Englander, maybe. So there's not a lot of investors that have, in the history of investing, that have proven that they can consistently sell the tops of market cycles and buy the bottom of market cycles. And so if that's what you're out there trying to do, I want you to realize it's okay to do that. I'm not certainly, I don't ever try to be pejorative in any of my statements. All I'm trying to do is help coach everyone who's willing to listen and willing to learn and sort of graduate up to the level that I've been fortunate to graduate to, which I'm not even saying is all that high, but it is higher than the average investor. And that's why we have a business, because we can, at the bare minimum, get you guys up to the level that I've been blessed to get to. And that in itself is of a service. You don't go to the doctor because they're just as good as you at doing open heart surgery or taking care of you. You go to the doctor because they're better than you at administering care. And so the same thing with investing services like ours. You want to go get services from people who are better than you at those things. But going back to this sort of conversation about taxes, the goal for, when I get questions like this, it sort of assumes that you're going to be able to consistently sell the top and maximize some sort of long-term capital gain every time you put on a trade. And the reality is nobody is good enough at investing to do that on a consistent basis. And so the sooner you realize that as an investor, the faster you will graduate up to the top portion of the distribution to recognize that you probably need sophisticated risk management overlays to go along with your fundamental research process to constantly keep you on the right side of market risk. And the cost that you pay to remain on the right side of market risk are short-term capital gains. The cost that you pay to not remain on the right side of market risk, which is what the bottom 90th percentile of investors are generally doing when you invest over a long, a full market cycle, the cost that they're paying is significant drawdowns in their portfolio. The S&P 500, reminder, the S&P 500 has crashed 7 times since 1998. That's like once every 4 or 5 years. The S&P 500 has crashed. So obviously it's telling you that all risk assets are crashing. Bitcoin loses about 75 to 80% of its value every 4 to 5 years when you go back and you study the price series of the time series of Bitcoin. And so the assumption that that these significant capital impairment events will no longer, will cease to exist is a very dangerous assumption in a fork turning and in a world in which, we're going to have fiscal dominance not necessarily be met all the time with the appropriate amount of monetary easing and the appropriate amount of monetization to keep the system going. We will continue to have significant drawdowns and pullbacks in asset markets. And so if your goal is to sell the top of every market cycle and buy the bottom of every market cycle, that's all of our goal, obviously. But if that should be your goal, by the way. But if you're supplementing that goal with just fundamental research alone, and you're hyper concerned about taxes, so much so that you're rejecting, very proven, very efficient, very effective systematic risk management overlays like KISS and Dr. Mo, then it's my reckoning, and then you may disagree, email me if you disagree, it's my reckoning that you're probably going to remain on the bottom, 50th percentile of that global investor distribution. You need to graduate to the top part of the investor distribution. And the only way you're going to be able to do that is by acknowledging that having the humility to acknowledge that you're not going to be able to sell the top and buy the bottom of every market cycle with just fundamental research alone. So that's why we use our systematic risk management overlays like KISS for retail investors and Dr. Mo for institutional investors, sophisticated retail traders. And the cost of using those systems are, small, short-term capital gains, sometimes, but that's a much better cost to pay than paying the other investors on the other side of your trades because your portfolio is down 20 to 50%, which is what a lot of investors are going to experience because they are refusing to use systems like KISS and Dr. Mo to stay on the right side of market risk. So hopefully that was long-winded, but hopefully that explains a lot of what we do and why we do what we do. If you have any questions about that, just hop in our community chat. If you're a client, or shoot me a question on Twitter, maybe I can help out and then convince you why this is the better way to invest for those of us who aren't good enough and emotionally disciplined enough to be Warren Buffett. So we'll wrap it up there. Darius Dale here presenting our macro minute for Thursday, December 12th, 2024. Best of luck out there. We'll catch you back here tomorrow. Cheers. Actually, I won't catch you back here tomorrow. I'm offline tomorrow. So I will see you guys on Monday. Cheers.